Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. Today we are interviewing John Comino, CEO of Bridge to Bricks Buyers Agents. John has been a property investor for more than 20 years and has been running the buyers agency Bridge to Bricks for a good part of the last 7 years. So, John, welcome to the Property Addicts Australia podcast.
Thank you for having me.
So today, you specialize in Sydney as a buyer's agent. But before we dive into what you do day to day or what your advice is for our listeners, would be great to hear on your story, who you are, where you come from.
Okay, yeah. So my name's John, and so I run a business called Bridge to Bricks, and we're property buyers agents. We specialise just in the Sydney market, and I've been doing this since 2017. By way of background, I'm a chartered accountant, so I came up through sort of the greasy corporate world, not through real estate specifically. But I was, my wife and I were sort of buying properties, and we sort of fell in love with the industry that way, and we came at it from a very different perspective. So we just bought sort of Sydney properties, and we just sort of had a buy and hold, boring accumulation strategy. But it also, buying property sort of got us out of some pickles from time to time. And so we saw it as a very sort of reliable anti-risk strategy. Like it was a way to sort of balance out the risks of life and particularly financial risks. And so we just decided in about 2014 to go all in. So that meant buying properties a bit more regularly, but it also meant eventually turning sort of my career into a buyer's agency. And so in 2017, we started Bridge to Bricks and haven't looked back.
Awesome. Thank you for sharing that, John. But just backtracking to when you actually started with your first investment or for your first home. So tell us a bit about how you got into property initially.
So the first property I bought was in 2006, and it was a townhouse in Five Dock. I was actually living overseas at the time. I did the usual London thing, and I was living overseas, but I wanted to get into the market, and I also was doing it because I was sort of preparing to propose to my then girlfriend, now wife, and I thought, look, I need to bring something. I sent my wife, my sister out, Freudian slip. I sent my sister out, who was living in Sydney at the time, to go and have a look at the property, and we didn't look at it a lot, but I knew what I wanted, and I'd sort of recognised Five Dock as an area that was sort of underperforming at the time, and she went and had a look at this property, and I remember coming back. It was tenanted, and it wasn't in a particularly good state. But I remember asking, "What did you think of the property?" And she said, like there's KFC packets everywhere. It was pretty gross. And I said, "No, no doubt, but like, what was the floor plan like? What was it like?" "Oh, it was great, great." So we bought it. It wasn't like there wasn't a lot of diligence that went into it, other than sort of some of the online checks that I'd done. But I hadn't looked back, and it ended up being a great property. Now, 2006 was, in a sense, leading up to the GFC. So in some respects, it was a bad time to buy. But what ended up happening was, like, it's gone up steadily in value, but also during the GFC, when the property wasn't going up in value, the rent started to spike, and so I always felt like it was always balancing itself out, but in a constant sort of inflationary trend. So I was always getting returns one way or another.
So you mentioned that you bought in Five Dock because you thought it was underperforming, but were you a local as well, or did you live there when you lived in Sydney?
No, I grew up in Eastwood. It was just an area I'd been looking at. So
Sure, because I know many people get hung up on that they need to buy a property in their backyard or where in the area they live in or nearby.
Yeah.
So you chose a different segment altogether.
Yes, and I can't remember why I was probing in that area, actually. I wish it was a long time ago now. But
so you didn't know whether you were going for capital growth or for cash flow?
It wasn't that deliberate. I was more looking for a property type in an area that I I liked at a budget that would work. The problem with that purchase was, of course, I had foreign income. Just getting a loan was really, really difficult, actually. And so, yeah.
So curious, what would a townhouse in inner west have cost in 2006-7?
So about $500,000.
That was peak of the Sydney market, right? Right after Sydney had peaked.
Yeah.
And what would be the current value?
About 1.7.
Wow.
Yeah.
That's incredible.
Yeah.
So it's three times it's gone since you purchased.
Nearly 20 years, though.
Yeah.
Yeah.
So
So property is not overnight. So for anyone wanting to make money straight away, they need to let time do its thing.
that's right.
So just curious, John, why did you stick to Sydney only and not, like, Australia's a big place?
Well, back then there weren't buyers agents really. This is pre-GFC, so there were even if I wanted to invest in Brisbane, I wouldn't have known how to. So that's probably the main reason. But the other reason is I didn't own any properties prior to that, and so one of the and I noticed this today when clients come to me wanting to buy property, even the investors still want the optionality to potentially live in it at a future state. And that was always at the back of my mind, that I wanted something to maybe move into, maybe not, at least in the very short term, have it be an investment property. And that's why I never really considered any other capital cities. And they may have been better investments at the time, but I never really considered them.
But even down the track, right, over the 20 years, you've focused on the Sydney market. Yes. So why not?
Well, because I wanted to. I see real estate as a very tangible asset. I think that if you start to turn property into an abstract asset, either through like a financial product like a REIT, or if you invest too remotely, like you invest in the US, I think you're taking away some of the benefits of having a tangible asset. I'm also conscious that eventually, like, the oven's going to break, it's going to need to be renovated, and while small things can be done remotely, I feel like it's something that I want to be able to see it. I want to be able to get involved in it, and I actually don't see real estate as an entirely passive asset. I see it. I think one of the mistakes some people make is viewing it as this sort of totally hands-off, completely passive asset. Really, it's not like an S&P 500 S&P. It is a bit more involved, and I never wanted to disconnect myself from that physicality of the asset. So I always wanted to be in proximity to it, and I've always invested in Sydney.
Great. And going back to the old debate of shares versus property, everyone asks. So tell us a bit about what your analysis and thought process has been there.
So I'm a property guy, and asking a property guy, like, if shares or property, it's sort of like asking the barber if you need a haircut. Like, this is definitely my wheelhouse and my patch. But I did some analysis recently on the difference over long-term performance. So I went back to 2000. I went back to 1980, which is 44 years of data, and we compared the performance of the ASX 200, top 200 shares in Australia, and the Sydney real estate market, housing market in particular. And what we found, that if we just look at flat capital returns, the share market does outperform the real estate market. So from 1980 to 2024, you would have had on average about 8.2% returns in the ASX 200, which is pretty good. It means it's doubling about every 7 years or so. So like that they're really good returns. And in real estate, you'd get less than that. You'd get closer to 6 to 6.5%. So that's doubling in less than 10 years, something like every 12 years. And so if that was the end of the debate, shares are a better performer. But there are other things to consider. I mean, for example, in the shares you can dividend reinvest, but importantly, in real estate you can get leverage, you can borrow. And so when I reran the analysis, and I said, well, what happens when you assume an 80% LVR and you assume that you're borrowing to acquire real estate? Well, then the numbers change, and so rather than getting 6.5% or 6.2%, whatever it was, in housing, you're actually getting 29% every year. And that turns what is a sleepy, kind of boring asset, some bricks and mortar, into a very dynamic growth on growth type of asset that really changes things. So 29%, now when you compare 29% in real estate with leverage to 8.5% in the ASX 200 without leverage, it becomes a lot more compelling. And this is why real estate generates millionaires.
Great. Thank you for sharing that. John, so if someone came to you today and, they were contemplating which part do they take, obviously, again, you said you're a property guy and that's what your advice would be, that they go and invest in property. But when it comes to, say, financial planners, right, they tend to probably promote share investing or manage funds. Like, what's your view of that? Or what would you tell someone if someone came to you and they said, oh, my planner said, oh, you should actually be buying shares rather than more property?
So I think it depends on your circumstances. That was always going to be my answer. But for example, what I neglected to mention in the leverage story is there's a cash flow implication. So you're going to get bigger returns on your deposit, but you're also going to have to service a loan, and sometimes that's difficult. So it's going to depend on your income, whether you go shares or property. But the main difference is really that shares are a lot more liquid. So over the last sort of 40 or 50 years, the index funds have emerged and they've become an alternative to savings accounts. So you can't get any return saving your money in the bank account. So what people do is instead invest in like the ASX 200 as an index fund. And that makes a lot of sense. So if you're looking just to save money and have on-call cash, shares are much, much better. If you're prepared to tie that real estate up, that capital up in for a longer period of time, real estate becomes a lot more compelling. But you've got to be prepared to invest for a long period of time, and you've got to be able to suffer the cash flow implications that often comes with real estate.
Well, talking about financial planners, right? They promote obviously shares, but then there's accountants, right, who also talk about brand new property or tax depreciation. Mm-hmm. Well, you are a chartered accountant by background, right. So did you ever buy property for tax reasons? Or, well, I mean, that's the first thing we hear when people reach out to us and say, I want to buy property. And we're like, why? What's important? They're like, save tax. Then
I've never bought property for tax reasons. I mean, I know that the negative gearing's a debate that rages on and it'll rage on after this conversation, but I don't see negative gearing as a tax break. It's not a gift or a tax rebate or refund. All that's happening is that your employer doesn't know that you've got losses elsewhere, and so by being able to claim losses on a piece of real estate, it just restores you to your marginal tax rates. And so not having negative gearing would be the distortion. Negative gearing removes the distortion. That said, I've never considered real estate for tax purposes, but
it helps, right? It helps to hold the asset, but it should not be the key driver for investing in property. But then, what about brand new properties versus established?
I don't ever buy brand new properties for clients. I know that there's depreciation benefits, which is positive, and it depends what your objectives are. And so maybe older investors would benefit from newer properties because you get better rents, but you also get the depreciation benefits. Most of my clients are looking for capital growth. Generally speaking, established properties, I think, perform better. Mm-hmm. I mean, there's always that sort of tug of war in real estate between the land that's trying to appreciate and the building that's trying to depreciate. Yeah. And so in this sort of ever-present tug of war, you want to buy something at the end of its depreciation life, so that sort of pull down in terms of value is quite meager.
Because you're paying more for a brand new building, right, in comparison to the land.
Correct.
And going back to the topic of shares versus property, the key thing we hear from our prospect clients is that with shares, they don't really know how to choose where to invest, what to buy, whereas property is more tangible. So they know where it is, what location it's in. So that's what people find easier about buying property in comparison to shares. So I guess when it comes to shares, either, you're researching at all times, even property as well. I guess you could make wrong decisions by using the wrong data effectively.
Yeah. Yes, there's more you need to know, I think, in the share market, because there's sectors and industries within industries, and actually with the share market, the biggest risk you're taking is actually management risk. So so real estate, I guess, is far easier than that. You're just benefiting from inflation. You've got a rent in the meantime, and so it's a slower burn, but it's also accumulative, and there's really no management risk, which is where people lose money in the share market.
So, talking about the Sydney market, is it overpriced? How do you compare it to the inflation?
Right. Again, buyer's agent, vested interest. But look, I don't think Sydney real estate is overvalued, and I think that this is kind of a trap that we all fall into because it feels expensive. It really does. Like when I look at the numbers and I think about my kids and will they be able to buy a property, it's hard to envisage how it becomes more expensive from here. Mm-hmm. But I view the economy as sort of in a bit of an everything bubble. So when we ask, is Sydney property expensive? The question really is Sydney property expensive compared to what? And right now, Sydney real estate's generally speaking cheap compared to the stock market. But it's also cheap compared to inflation. So real estate has underperformed the general debasement of the currency at least since COVID, right? So there was a good, real estate went up a lot in 2021, but it's done very little since, and it went down in 2022. But inflation's burned ever since. So the general level of prices is going up faster than property prices. And one of the things, and so I think that real estate has underperformed inflation, which is why real estate has become quite cheap, and certainly underperformed inflation since 2020, since COVID. One of the things I do is compare real estate to gold. The reason I do that is, and you say, why gold? You might say, because I don't want to measure anything over a long period of time in Australian dollars. Australian dollars leak through this process that we call inflation, and so current national currencies are just a terrible store of value. So you want to compare an asset to something that doesn't lose its value. It's like measuring my height in a tape measure that's getting longer and longer. It's like, this year John's 7 foot tall. So now John's 8 foot. Like John hasn't changed. The tape measure's changed, and that's what measuring anything over long periods of time in currency does. So you want to find money that doesn't lose value, and gold is an excellent way to have a comparison in real money over long periods of time, and not to dwell on it, but the reason that the gold price pans across like the Bloomberg screen is because we're all comparing the Australian dollar against the US dollar. But how do you know if the US dollar is losing value? And it's against gold, and that's why gold's important. It's the money par excellence. That's a French word. So when we compare real estate to gold, what it's doing is factoring in a loss of value of the Australian dollar. So it's a loss of purchasing power of the Australian dollar. And what's actually happening is, rather than real estate just goes up every year, what's actually happening is real estate goes up and down and is trapped in a valuation channel. So sometimes it's overvalued and sometimes real estate's undervalued. And what you'll see is that real estate's actually, Sydney house prices in particular, are actually just bouncing between 400 and 600 ounces to buy a median house. And so when it's at 400 ounces, it's cheap. And when it's at 600 ounces, it's expensive. And sometimes it breaks out of this range. So like in 2004, after the Olympics in Sydney, we had a hyper bubble. So real estate was super expensive, and it peaked out in 2004. But there's also been times in the 70s where it was before they deregulated banking and everyone could get a loan. It was hard to get a loan, and real estate was relatively cheap then. So is real estate expensive right now? So real estate has broken below that floor price priced in gold. So it's at around 370 ounces to buy a house, which is on the cheap side. And I know it's hard to come onto a podcast and say Sydney houses are cheap, but if you think it costs $40 to buy a movie ticket and it costs $10 to buy a loaf of bread, Sydney houses don't seem so expensive compared to other goods and services in the economy.
Oh, I just ordered $16 bread this morning.
There you go.
On Uber.
But there's so much currency sloshing around in the economy, and we're in this sort of everything bubble. And so where does real estate sit?
But what do you tell, say, to a first home buyer or someone who's upgrading their home that Sydney's cheap? Because
Yeah.
I know, like, looking at clients' finances, I have seen an uptick in incomes over the last couple of years, especially, which has improved people's borrowing capacities. But like an average person, what do you tell them? Like, well, because property prices are cheap in comparison to gold. Then
Yeah. Well, I guess to sort of cut through a little bit, I think real estate in Sydney had a massive correction last year. It's just that we couldn't see it. It was in the Australian dollar lost 15% of its value last year. That means everything denominated in Australian dollars became 15% cheaper, including our salaries, by the way. And so all real estate had its correction last year in what they call a silent crash. And so what would I tell someone who's looking to buy property? I mean, I guess I'd say you can't save yourself rich. You need to buy, and if it means taking out lender's mortgage insurance, you should consider that. But I'd also say that the earlier you start, the better, because in real estate we're really just playing the inflation game, and because inflation is a cumulative phenomenon, you want to start as early as possible.
yeah, absolutely. It's more time exposure that you have. The longer you hold the asset, sure, it will cost you money to hold, but the longer you have it, the better chances you have of multiplying your wealth over time.
Or having access to multiple property cycles.
Correct. One way to look at it is you're either late in the current cycle or you're early for the next cycle. So particularly if you're young, you shouldn't worry too much about that.
And then talking about property cycles, so you touched on how market was overvalued in the early 2000s post the Olympics. And I know Sydney peaked 2004 to 2005, and it didn't do a lot until 2013.
Correct.
I mean, it some parts grew at a slower pace, but not much was happening, because when we used to go to open homes back then, in, say, 2010, 11, 12, there literally used to be nobody at the open homes, and be like, why aren't people buying? It's just crazy not to be buying in Sydney right now. Then it started in 2013, and then it kind of peaked in 2017 or thereabouts.
Correct.
Yeah, there was a short time and it paused in 2015 for a little while, but then it took off again in COVID. So relative to all those times, where are we in 2025?
It's hard to know, because with property cycles, you need to know when they began. So I broadly adhere to the 18.5-year property cycle, which you would have heard of. So I broadly agree with that. And I've got a video on my YouTube channel. But the catch is always, when did the cycle begin? And most people think that the cycle began, I want to say, in 2012. And so it'll probably peak out in 2026, 27. Probably. But that kind of ties into the gold thing. So if we're cheap now, that means the next couple of years are going to be potentially explosive. But again, if you're young, you shouldn't worry about the property cycle. But I do think that real estate is going to have a good couple of years.
So you refer to 18.5-year cycle. So I've heard that analogy, or that concept as well. So does that mean if it started in 2012, perhaps in the next few years, if real estate does well, then perhaps there will be a big crash again?
Potentially 2027, there's a 2008 style event, and maybe it goes. I mean, the theory is that you have the crash and then it goes sideways for 4 years, like 2008 to 2012.
But does that apply to Australia? I know it's a global concept, but does that apply to our country? Because we're such a small population and growing population, we don't have enough houses to go around here. So my take is that Australian property prices only go up. Like, we just don't have enough houses to go around.
Yeah, I broadly agree. I think it's, as in terms of assets, residential real estate in Australia is a relatively safe thing. I guess the 18-year cycle sort of reflects that there are social factors and economic factors that play out in the same sort of cycle, and there might be political interventions to address housing unaffordability, and they always sort of happen at the same time in a cycle. And so right now we're going into an interest rate cutting environment while there's still inflation hanging around. So that's very, very bullish for real estate. And, I mean, I think that the economy isn't doing great, but certainly if the mandate's low inflation, we're not on top of it and they're still cutting. So that would suggest that real estate's probably going to do quite well, and maybe they shouldn't have been cutting so soon.
So what would be the drivers for investment in Sydney?
As opposed to other capitals, or just in general?
Just in general.
So Sydney has underperformed the other big capitals for a couple of years now. So if you're sort of looking at, I think Warren Buffett talked about markets as a weighing machine, and sometimes things become cheaper than their peers, and then they become more expensive. So so Sydney is cheaper than Adelaide, Canberra, Brisbane, Perth.
Really?
Yeah.
How so? The median's higher though, right?
Well, it's cheaper so if you do the Sydney to Brisbane ratio, it's just going up and down over time. And then when it goes down, Brisbane's expensive. When it goes up, Sydney's expensive. And we're towards the Brisbane expensive. And you think about it, like Brisbane's outperformed Sydney for at least the last couple of years. And that Sydney to Brisbane ratio is now in Sydney's favour. So Sydney is cheaper than every capital in Australia except for Melbourne and Darwin. And so why invest in Sydney? Well, Sydney attracts the most amount of migrants, so it's fairly, if you're talking about demographics, it's a bit of a safe play. By the way, other capitals do really well demographically as well. There's a lot of interstate migration to Brisbane, and I'm not anti any of those capitals, by the way. But Sydney has really good sort of infrastructure coming online. Other capitals do too, but all the metros are really positive. But I just think that if you think of that weighing machine that Warren Buffett described, Sydney is cheaper than the other capitals. And that doesn't necessarily mean that right now it's going to outperform, but it means that because there's momentum, right? So I think that there's still the wind in the sails of Perth, for example. I think Perth will still do better. But relatively speaking, Perth's more expensive than Sydney.
Oh, well, it's unaffordable. I think it feels so much more expensive.
Right.
Yeah. So for someone who's looking to buy a property in 2025, what would you say to them?
Well, it would depend on budget and all those sorts of things. But I would say, I would say get in. Like, I think it's important to have it. And it's not just that you want the trophy or you want or you want somewhere to live. You also want to start establishing like a credit record. You want to be ultimately, real estate is a game of finance with some bricks thrown in, which I'm sure you've heard. But you want to sort of start establishing yourself with the bank as a customer. And so you should, start investing. But what I would say in terms of asset type is that, apartments, old walk-up apartments, have languished since about 2017. They're very good value at the moment. And in a sense, they're probably one of the cheaper kind of asset types at the moment. And to illustrate, like the average unit in Sydney, let's say you buy a 2-bedroom unit in Ashfield, you can probably buy it at replacement value. What does it cost? 800,000. What does it cost to build a unit? Probably 800,000. So, and I'm not saying that that's the best asset, but I'm saying you're essentially buying into these old red brick walk-ups at replacement value. So what I'd say to someone starting out is look at the apartments, but look at 3-bedroom apartments. 3-bedroom apartments in old blocks, they're a thing of beauty. Great investing.
And is now the right time?
Well, I think starting early is important. But I would refer, my goal to real estate ratio suggests that it's quite cheap at the moment.
So if you're ready to go, then you must take action.
Yeah.
And how long? How big is this window of opportunity? Like, what's the length in your opinion?
Real estate will have a good 2 years at least, and then we're entering 18-year cycle territory. So it's hard to know what happens there.
2 years to get in, or 2 years before the growth happens?
I think the prices will be rising for the next 2 years. We already see it. I tracked the CoreLogic daily data, and it's starting to fire. So we'll see what happens in the market.
So when do we see the explosive boom we had in 2013?
Don't know.
But I don't think even COVID. We were not buying in Sydney for clients during COVID. Yeah. But perhaps Sydney did grow a lot even in those times.
Yeah. Sorry.
Oh, well, it grew a lot in 2021. There was and Sydney, I think, was the best performing city, and I think it grew like 20%, but I think it gave most of that back in 2021. Sure. And then, yeah.
Because going back when, the boom started in 2013 or 2012, as you said, it's kicked off in 2012, what we felt was like week on week, you had to pay higher and higher and higher. Like, and that's what we've seen in Perth and Brisbane as well, right? Like if a property sells for, say, pick a number, 650 grand, the next one will sell for 670 grand, and so on and so forth. So it's like you're chasing the market, really. Do you see that happening in Sydney anytime soon?
What I see is that it's not a feeding frenzy at the moment. I definitely see more buyer activity, but I think it's a healthy market. I think that it's not exactly in balance because I think that sellers are beating buyers at the moment, just starting to. But not a feeding frenzy. So I think that there's reasonable buy. I mean, I think sellers are open to reasonable offers. But generally speaking, I think the market troughed out in about December in what was a very shallow correction.
Yeah.
And I think we're back into a fairly stable but rising market at the moment.
Would there ever be a crash in Sydney?
Well, I think that these tantrums get taken out in the currency market. So last year, Australian dollar lost 15% of its value. That means property went down by 15%. But I don't think in nominal terms. There's our demographics are quite healthy. That we've got lots of population growth. There's been a lot of good infrastructure in Sydney over the last couple of years, and I think that there's a bipartisan vision for Australia to have a much larger population, and I think that there's nothing, neither parties can interrupt that process. So I think, 27 million people? I think that we're going to keep growing, and I think that housing won't keep up. But I don't think. But it is an immigration story. Like there's not. We don't have a housing shortage because of birth rates. I mean, it's entirely like self-inflicted. This housing.
But we have a lot of land too.
Yeah, we have a lot of deserts.
That's true.
Yeah, no, we do. Like we have space, but
like Sydney is landlocked, right? We know that. Yeah. Melbourne's got a lot of land. I'm not sure. Perth seems to be filling up. I don't know which direction it will grow in. Brisbane's ever growing, but yeah, I guess Sydney is because of it being landlocked. That's another reason for the prices.
Yeah. It's there's a lot of population growth. We get a lot of young migrants too, so that's really healthy. So I think that there's going to be a lot of demand for property, and I think that most migrants, I think they buy within the first 5 years. So I think that initially you see, I mean, the best indicator for general scarcity in the housing market is the rental vacancy rate, and I know it's a rental measure, but it does speak very immediately to like surpluses and shortages, and we've got shortages.
And rental growth, I know last few years we've had a bit of rental growth. Are we still expecting that over the coming years, or not really?
I think you'll always get inflation. So I think you'll always get, let's say inflation's 2 or 3%. I think we'll continue to get that. It's been pretty hot though the last couple of years, and I think 18 months ago there were lines outside of every rental. I heard anecdotally someone I was speaking to yesterday or the day before saying that I was sort of implying that the heat's come out of the rental market, and this guy was saying I had to line up for a rental last week. So yeah,
it maybe depends where.
Yeah.
Great.
Yeah. Well, thank you so much, John, for joining us today. It was a pleasure having you in our podcast, and yeah, we'll catch up again for part 2.
Thank you.
Thanks for listening. Join us next time for another episode of Property Addicts Australia. If you have any questions, comments, or you need help, feel free to reach out.